Welcome to episode 30 of Sean's Take on Asia, where we touch on the latest news on digital asset development and policy updates. Last week's big news was Hong Kong conditionally approving its first spot Bitcoin and Ether ETFs on Monday, paving a way for the city to become Asia's first to accept the cryptocurrencies as a mainstream investment tool. Now, what does it mean to be conditionally approved? Well, according to the SFC, it means generally satisfying its requirements, including fee payments, filing of documents, and the Hong Kong Stock Exchange listing approval. The expectation is that the first approved ETFs should hit the markets over the next couple of months. Now, quite a few folks have been asking me, so what's the big deal about Hong Kong launching its own spot virtual asset ETFs? They can't possibly compete with the big US players, which is very true. However, there are several factors to consider, creating the possibility of market success. Let's talk about these. First, Hong Kong operates in the Asia time zone, different than the US trading hours, with the physical digital asset being traded 24/7 on crypto exchanges, which is quite different than traditional stock markets. This creates tremendous trading opportunities for institutions and market makers. This is healthy for the overall markets as it boosts market liquidity and diversity. Second, what sets Hong Kong's spot ETFs apart from their US counterparts is their in-kind feature, which means that if you already own physical, say, Bitcoin, you can essentially switch them to equivalent units of a fully regulated spot ETF managed by a professional fund manager and custodians, providing the ease of trading as well as reducing various risks such as hacking or lost private keys. For investors new to Bitcoin, this won't matter much. But for those who have existing Bitcoin, especially for miners and validators, this becomes a viable and compliant mode of ownership and off-ramp. This applies also to Ether, which is still not approved in the US yet. Now, let's also clear up some of the myths as well. First, the approved spot Ether ETF does not have a staking component, and it is currently behaves the same way as the Bitcoin product. It is essentially the same as holding Ether in your wallet, but not participating in any staking protocols. Having a spot ETF that also supports native staking will definitely take more time for the regulators to fully consider the consequences and thereby obligations for those parties involved, especially since many staking providers are currently not running onshore in Hong Kong. Lastly, the big myth around mainland China volume. Yes, there is indeed tremendous appetite from Chinese investors in both Bitcoin and Ether. There are those who hold the opinion that many of these Chinese investors may access these spot ETF products via the Southbound Stock Connect program, which allows qualified mainland investors to trade eligible shares listed in Hong Kong. With that said, the program currently does not allow mainland investors to invest in crypto futures ETFs in Hong Kong. Hence, it is unlikely the rule will change for spot ETF products in the near term. That's all for the week ending April 19th. Until next time, keep innovating and keep demonstrating the transformational promise of Web3.